Okay. Just double checking that we've gone live. Okay, yes, looks like we are live. Welcome everyone. This is Ivan Delgado, market as commentator at the Gold Prime Brokerage Firm. Today I have the fortune to be sharing not just the name but also the passion with towards the markets with DG Ivan. Ivan has been an active Discord user in our stocks and also in our crypto channels. Remember that as Global Prime, as a firm, as a brokerage firm, we actually are first and foremost proponents of transparency. We are proponents of really saying it as it is. And for anyone that is a critic of businesses or dealings of brokerages, to, I guess, voice concerns through the Discord. So there we built a tight-knit community, and Ivan has been making a name for himself. How are you today, Ivan?
Oh, I'm fine. How are you?
Excellent. By the way, I wanted to ask those that are joining, please let us know if you can hear and you can see the image neatly enough and crisp enough. If that is the case, we will be proceeding. I will just be, I guess, just simultaneously talking to Ivan, but I just wanted to make sure that everybody can hear us and that we don't run the risk of talking and people having some technical issues. So, Ivan, anything else that you'd like to ask, you'd like to add? Like I've been introducing you as an active member of our Discord room, and also you seem to have a keen interest towards volume profile and a few patterns that have been, I would say, quite instrumental for how you approach the market. So take the floor, give us a bit of an introduction about yourself.
Well, I actually started trading it's almost 10 years now, but I started with crypto. I was fortunate enough to be early in the game. And what I'm doing with the volume profile now, I've been studying it for a while now. I've talked with Greg about it a little bit because I initially thought about combining volume profile with Elliott wave.
Right.
Because I saw some striking coincidences with or correlations between Elliott wave and volume profile levels. Well, anyway, what we did back in the day, I had a mentor with crypto, and what we did was we kind of we only traded Bitcoin and then later Ethereum. At least I did, and before I switched to altcoins in 2017, I think, before the big market crash. And what we did was fairly straightforward. We kind of marked levels where there was a huge sell-off and a bounce, where the buyers came in, and we marked those areas. And whenever the price dropped below those high buying areas, we just layered in and we rode the wave up, because the thought was, well, if there were big buyers in those areas and the price drops massively below that, they will come and they will jump on the opportunity to buy even cheaper. And it worked like a clockwork. You couldn't lose money doing that. It's really, and it still works, to this day. I'm kind of surprised that there are actually people losing money trading crypto, because, I mean, when we are talking about cash accounts, not leverage, that can obviously go really bad. Because it's just going up, and if you buy panic sells. Well, anyway, at some point I thought, well, we didn't have a clear structure to where we are going to start layering in our buy orders. So I kind of thought, well, I want to know where people are actually buying, like the big buyers. So I kind of discovered volume profile, and I just started experimenting with it. And as I have shown with Ethereum now, for example, a few days ago, when you look at where price stopped like dead in its tracks is right at the POC of this huge triangle we broke out earlier this year. So obviously, you know, you can just, if you adjust yourself to volume profile levels for your entries, you have a massive edge, and I'm kind of surprised that not many traders use it that way. I see some traders, they say, well, sometimes the POC works or the value area high or low or whatever, but sometimes price just smashes through. But I hope to show you later why that is the case, because obviously there's narrative on the chart that you cannot ignore. Well, anyway, and then I did it. I started trading altcoins in 2017 as well, and it worked well before the crash, and it was really nasty. And so in about like early 2018, I thought to myself, well, maybe I should expand a little bit more into traditional markets. That's when I started losing a shit ton of money trading Forex, because Forex is obviously a totally different beast than crypto. And so I burned my fingers with Forex.
When you're saying a total different beast, what do you mean by it? What are the main distinctions that you would notice between Forex and crypto? Volatility?
That's a great question. The thing is, when you look at stocks and crypto, I kind of like to take them together. It's like stocks have this, when you're talking about companies and their share values, they have this tendency to go up if it's a good company, obviously. You know, the EPS goes up and all that with high sales growth. So you have this upward tendency. And I mean, crypto, we are not sure yet. You know, we still in the discovery phase of it. We don't know what exactly is the value of the whole thing, but it does display this upward trajectory still. You know, so people are interested in the price going up. And with Forex, you don't have that. It's not like the Canadian dollar has to go up or something, you know, but it's actually detrimental for the economy. You know, you have all these kind of factors. So you can't say you have an upward bias or anything as you have with stocks and crypto. It's not possible.
Yeah, what I would actually add on top of what you just said is that by default, the stock market is meant to actually grow in value as companies and prospects and earnings keep actually also being upgraded. And then on top of that, if we actually add the layer of the Federal Reserve throwing cheap money into the mix, that obviously creates that, I guess, upward trajectory. Whereas Forex, you actually have the interaction of two currencies. So there's always going to be a bit more of a mean reverting effect, because euro at times can appreciate against the US dollar, but at times the US dollar will go through a strengthening phase. Therefore, euro US dollar might end up being range bound. So I totally get what you're saying, because it is, as you very well define, a total different beast. Trading Forex and then trading instruments that are going to be, I guess, attached to the denomination of the US dollar, but they are actually a single instrument. You're not trading Apple versus Facebook. And that is precisely what we're doing in Forex, trading one asset against another. Great remark right there. So I just want to keep moving forward. What would be your trading method? Because one of the things that you've mentioned in our Discord room is that it seems like there was someone out there by the name of Oliver Kell. And let me just show to the audience the profile of Oliver Kell. He is a 2020 US investing champion, and he seems to have been an instrumental in your, I guess, progression as a trader. He has what he calls the wedge pop and then the wedge drop for setups, and then you seem to have been creative enough to add into the mix volume profile and then see how these patterns tend to break out, and then there's a revisit into the POC or into the value area of that POC. That would be like the upper area. So perhaps you can elaborate a bit, and simultaneously I think this is about time that we can start sharing your screen. So just head to the top right hand side and find the three dots, vertical dots, and then just click on share screen. Just remove my ugly face from there, and then just stick to your chart. There you go. Perfect.
Well, Oliver Kell is like one of the traders that I'm interested in, and I like to incorporate their method. And it's the same thing with, for example, Greg's Elliott wave analysis. I discovered that there is a huge correlation between the levels where, for example, Greg enters a trade, or Oliver, or other traders with a proven track record, and the volume profile. So there seems to be, they're not aware of it, because obviously Oliver and others, they don't look at the volume profile at all, which I find kind of strange. That's what I'm saying. It's kind of ignored. It's not a tool that's been utilized properly. And so I thought that that's what I'm currently doing. So I'm not saying that there are many aspects that I'm still tweaking and working on in this combination of, for example, the wedge pop and volume profile. But as I will show you in the charts in the next half an hour or whatever, you will all see how it's almost eerie how exact you can, how precise you can work with the volume profile in stocks and crypto. It's almost like a clockwork if you if you utilize it properly. And there are many misconceptions about volume profile that I would like to kind of get to talk about.
Yeah. And by the way, we haven't really touched on the explanation of volume profile. Maybe I'll back you up here real quick. So essentially, volume profile would be looking at the visual representation of the total traded volume in the price axis. Okay, so you're going to have at times volume being analyzed through time from a time perspective, and then volume analyzed from a price level perspective. So volume profile looks at volume through the y-axis. Go on.
Exactly. And there's one thing I tweaked the volume profile a little bit. If you see here, for example, and that's important, we have this, what I use is the visible range, not the visible range, the measured range volume profile, whatever it's called. But in the, like in the settings, I don't use, normally people use number of rows as the rows layout.
Okay.
I use tick per row, and you will see there's a huge, I mean, this is just a mess, but if you see the way I use it here, you can really, let me zoom in a little bit, you can really see those bulks of volume at each price level. So you can really see where there was a huge or like a significant participation of traders. And this is the key to it. And one thing that I have to mention, which is really important, we shouldn't just focus on the POC or value area low and high, because you obviously have other bulks of volume across the whole spectrum, as you can see here. And especially when it comes to the value area is 70, I don't know, maybe all of you know it, but for those who don't, the value area, this blue shaded area, it displays 70% or about 70% of the whole traded volume in this marked area. But 70%, that's just a number. If you zoom in here, you see this blue where it turns from blue to white. This is the value area high, but it's not the value area, this turning of the color. It's not the important thing. You have to look at the volume nodes around it. These are the important parts, and not just the shading based
Correct.
on this.
And just to clarify, high volume nodes are these subsequences in the chart with high volume activity.
Yeah, exactly. Low volume nodes are also important. I've been kind of trying to wrap my head around those, but there's so much work to be done with volume profile that
these are the high volume nodes right there. Sorry, I'm just marking. Just keep talking. I'm just marking the high volume nodes through the chart.
Yeah, just tell me if you want me to kind of like move it or zoom in
All good.
or whatever.
All good. Go on.
Yeah, so this is the basis of it. Like you said, with Forex, it doesn't work, but with stocks and crypto, you obviously have an immense edge if you can see where we had a big participation or significant participation of traders. And if you think about stocks, when you look at some stock screeners like, let's say, Finviz, you can actually see what amount of stocks is in the hand of hedge funds and like big trading firms and all that. And it's usually about 70 to 90%. So obviously, if you have a big move like this, and you can slap on the volume profile and you see this huge participation area here at the POC, that obviously means that the hedge funds and all the other big fish, this is where they traded the most. So to ignore that and don't utilize this information is just, you're kind of driving, you're driving in the dark, without headlights.
Okay.
Yeah.
Good analogy.
Yeah. So any questions so far or anything that I should clarify?
Well, not really. I mean, I suppose that by now, and with the backing of the explanations that I've done on the sidelines while you were talking as well, in terms of high volume, nodes, value area, I suppose that the next step would be, okay, so you pay attention to these high volume nodes and to the POC, which in the case of Amgen, this stock that you are displaying, it seems to be around the 237 or thereabouts level. Okay, so
exactly.
Once you've detected that POC as part of your decision-making process, what is the next step? What are you looking for? Are you looking for a specific pattern, like a wedge pattern?
Yeah.
Go on.
I don't think we have the time to get into the whole evolution of this, because it took me quite a while to go to this stage of volume profile analysis. But maybe I can do that separately in the stock room, because it's actually quite interesting to explain how I came about to use it this way. But anyway, if you let me just switch to, this is Oliver Kell's book that he recently published, Victory in Stock Trading, which I can highly recommend. And I mean, he made almost 1,000% last year, so this guy knows what he's talking about. And if you see, for example, a wedge pop, his wedge pop definition is this here. You see the white line that I drew in here?
Yeah.
And just to clarify, this is one of my open positions right now. These 7 stocks that I have here, I'm in them. Some of them are low conviction trades, some of them are bigger conviction trades. But anyway, Oliver Kell, he says a wedge pop, it happens when, for example, you see here this big sell-off below these 2 EMAs. We have the 10 and the 20 EMA. And it kind of starts ranging, narrowing, consolidating below the 2 EMAs, and then it pops out of it, it breaks out. So this is the wedge pop. And let me just delete everything here.
Yeah.
And if you look at this, he trades the wedge pop, obviously this breakout. But if you start slapping on the volume profile, and my idea is many traders would, for example, they would pick, for example, the low of this up move and the high of this up move, to anchor the volume profile. But I don't think that's right, because I don't care what happened up here. That's not relevant for us in this specific case. We had a sell-off, and now the price is below. It started wedging below the 2 moving averages. Yeah. So I want to know what happened down here exactly. I want to know here we had this sell-off, this gap down and sell-off below even the 200 MA, and then it started rallying up. So I want to know what happened when the big up move initiated. That's the area that I'm interested in. Now, of course, you can experiment. It's not an exact science. You can anchor it up there. But for example, let me just anchor it. You see the big sell-off after the gap down, and then when it started rallying, so I anchored the volume profile there. And now look at this. You see the POC and you see the volume area low, which is the volume area low is at, let's say, 233. Now look at this. Look where the stock stopped dead in its tracks, exactly like almost to the dollar at the volume area low. Now, some may say, well, this is a coincidence, but I can go through all the 80 or something stocks that GP currently offers, and you will see this repeatedly happening. So this is not just, this is a trade that I'm in, that's why I'm showing you this, but I can show you others. Well, anyway, it stopped dead in its tracks. And here's another interesting thing. When you look at AMGN, we have earnings release in 27 days. That is something that I mentioned in the Discord room. These setups, especially wedge pops, how Oliver trades them, he doesn't seem to be aware of it. He doesn't mention it in his books, at least. These setups, they tend to happen about 4, 5, 6 weeks before earnings release or shortly after, maybe a day or a week after earnings release. So that's very interesting. I don't know the market mechanics. I went to business school for 3 years, but I have no idea how the stock market works, obviously. Anyway, so here's the idea. As you can see, once you can actually predict this. So let's say 5 weeks before earnings release, the price starts to sell, the stock starts to sell off. It drops below the 2 moving averages. So you have this wedge forming, you have this consolidation, and you see the consolidation starts when we touch the value area low. So this is when you have to start looking at a possible entry. Now, what I like to, my first idea was, all right, Oliver waits for, you obviously can't just jump right in. If you would have tried to catch the falling knife, as it's called, at the POC, you know, you would have burned your hands because it dropped further to the volume area low. So this is obviously the big question, is how do we know when it will start to go up again, when it will change the trend? Now, Oliver waits for the breakout, and you can do that, but here's something really interesting that I want to show you. Like, one option is, let's say we had this gap down here, and then we hit the bottom here, and this is around the 9th of July is when we started really popping out of this wedge. So what I like to do is I mark this consolidation area, you know, I slap the volume profile on it, and like right before the big breakout. So as you can see, again, look at the volume profile. See where we had this breakout and then the stock retraced right back to the volume area high. See how it doesn't really break below it. It dips to other high volume nodes, but it doesn't manage to break to go much lower. So again, you see the volume profile, significant levels, stopping the stock, the sell-off, pretty much dead in its tracks. So you can actually try to enter on a retrace after a breakout. It doesn't retrace all the time. Sometimes the stock just moves up and never comes back. So you have to kind of develop an intuition when it's probably not coming back or all that. But I have something else that I want to show you, which is really important. So in this particular stock, you could have entered on the retrace, obviously.
Yeah, you said that you have gone long on this stock. What was your entry point, and what was the trigger for it? I believe
exactly. I'll come to this in a moment.
Excellent.
But what I want to show you here is one thing that I should mention. These are not day trades, short-term trades. Now, if you had if you enter, for example, if you wait for the breakout and retrace, you would have been in this trade already for like 2 weeks or something, you know, and maybe it will take another week or month until it reaches your take profit level. So you have to be mindful of this. You know, it takes time to unfold this trade. Day trading stocks is, in my opinion, just a sure way to lose money, especially if you look at this. I mean, see this when it started to trade around the value area high, it just chopped up and down. You would have, you know, lost a lot of money trying to day trade this. It's not possible. So you have to be in it for the long run when you trade stocks. Now, here's the thing that I want to show you. So right now I kind of highlighted with the volume profile the sell-off after the drop down, the get down, and kind of like the breakout. Now here's where it gets really interesting. Let me remove this so we can see this better. The weekly volume profile is very interesting. As you can see, again, the price, the stock stopped at let's say 233 thereabouts, and that was on July 1st. So that was a new trading week, yes. And the trading week ended on let me just 1, 2, 3, 4 here. It ended on July 4th. Is that? Yeah, so we only had, so we have these 5 trading days. Now, I want you to pay attention on the 8th of June. That's when, no, on the 7th of June, sorry about that, is when the new trading week started. You see this? Look where, that's Monday, where I'm at here. Look what happened on Monday. The price dropped in right, like pretty much to the cent, to the weekly POC, right? And then on Tuesday again, and then it started rallying and breaking out of the wedge. And this is no coincidence. This is and this is how I entered here on this trade. I actually missed this one. The initial entry would have been here on the weekly POC. And I will show you similar examples of it because I don't even know if Global Prime offered this stock back then. It was at the beginning of June.
Yeah.
So what I did is this here.
So would you be at times, and allow me just to cut you real briefly,
Sure.
would you at times be front running your entry ahead of the wedge breakout?
Exactly, that is the idea. And
Okay.
you can do this. It's a little bit more aggressive, but you can do this when you utilize a weekly volume profile.
Yeah.
And you kind of, it's not an exact science again. You have to look at the context and everything. But as I said, we touched, in this example, we touched the value area low.
Correct. Yeah.
At the 1st of June, and then we moved away from it.
Yeah.
And you just mark you analyze, you slap on the volume profile for that week, and you know, next week, come Monday, I will try to enter ahead of the breakout of this wedge pop on maybe the value area high or the POC, or maybe the value area low or another high volume. You have to kind of figure it out for yourself.
And do you typically have the nerves that it takes for you to hold this position, watching the wedge pattern breaking out, and then the price pulling back all the way to your entry point at that time? I think that's like June the 20th or so. Would you still be holding your total exposure risk, or would have you moved to break even given that explosion of demand we saw of that weekly entry? Elaborate on that.
Yeah, this is a great question, and I mean, I don't think we have the time to go into all of it, but obviously it ties in together with the targets that I have. I use, in this case, I would at first, I use as a target, I use volume profile levels as well.
The opposing
So in this
POC,
case,
I can see there 252, yeah.
Exactly. At first I just moved. I just anchored it to this whole down move. This is the first step, and then, like I said, I don't care what happened down here. As for my target, that's not relevant. I want to know what happened up here, and you see the POC is still the same.
Yeah.
You know, it didn't change. So obviously this will be my target, or maybe an area where I utilize as a trailing stop. And what's interesting here, because you said, would you hold on to your trade?
Yeah.
As you can see, the price broke out of the wedge into this high volume node and into this gap. We had this volume gap here. You see there wasn't any volume here at all. And then it started to sell off. Now, this is interesting. You might get cold feet, but this is why I think Oliver would have cut his trade with a loss or break even at this point. But think about where we entered ahead of the wedge pop. We entered down here, you know, at 255, you know, at the POC of the first week of June. So we are still in the clear. So really there is really no like necessity to cut the trade already. You have to be obviously careful when you see price falling back from a high volume node or something like that. You might think, well, maybe this won't work out, but you have to consider, look how we don't even drop below the 200 MA. So as you can see, it's struggling here, and it broke out again. So this reinforces our initial idea. And again, we have 27 days to go to the earnings report. And obviously price doesn't want to move lower before the earnings. Now this should kind of like show us that there's people with interest, you know, big fish with interest, that the stock doesn't move lower. And
what I personally find really hard to stomach, and I haven't really come across that many traders that, assuming that you enter on that very advantageous position around the 236 or 37, or that you would have entered, I'm not sure if you actually missed it or not, but that should be the supposed entry point. That actually makes your stop loss placement to be rather tight, because there's no point placing your stop way beyond that low, right? If that low is taken out, that's an invalidation of the trade, I suppose. Like sellers are taking over. Okay, so based on that entry, my point is, it is really hard to stomach psychologically, and I believe that still psychology is the number one indicator that the majority of people really overlook. That trade would have gone for about a 3-to-1 risk reward. So essentially you're telling me that after a 3-to-1 risk reward, you have, let's just say, the balls or the nerves of steel to actually still allow full risk open and returning back to your entry point and holding that position, because it literally came back to your entry point. So that would have been like a 2.5 or a 3-to-1 at least. So that's the thing that personally, based on my trading profile, I would never allow myself. After my trade goes for 3-to-1. Now, that being said, I get your point as well, which is you go for far bigger targets. So perhaps you are willing to sacrifice that small loss for the big run.
Absolutely. With stock trading and utilizing volume profile and wedge pops and all that, you don't aim for 3-to-1. If I had caught, now I show you where I actually entered this trade after I discovered that GP offers this particular stock. So
we've been expanding the stocks. Now our offering has expanded to over 80 or 90 stocks. So we're getting there.
Exactly. So I will come to my entry in a second. But obviously, you see, I just, because you said you couldn't handle this, but look at this. We would, without leverage, you know, with a cash account, we would risk, let's say, 1%, because the question is, where do you place your stop? Obviously, you place your stop according to the volume profile level. And as you can see, I would have placed my first stop here at the volume area low of this week that initiated the breakout. So this would be our first stop, and I would actually re-enter it. So if it would have taken my stop out here, I would have re-entered lower at this, because I'm pretty convinced that this might go up.
Yeah.
I mean, this is obviously anything can go wrong, especially if you look at the SPY.
Yeah.
The S&P 500. Many traders, including myself, we are kind of worried that this thing might roll over any day now. I think Greg has a better idea of this, because he actually projects upwards with his Elliott wave theory. And I don't know, but I think he said 4,500 or something is his target, so we are well off with that, but who knows, and this can obviously drag down the whole this stock. So anyway, but if you look at this, we would have risked 1% to make almost 7%. And I get 3-to-1 with Forex, because Forex is way choppier and usually doesn't have these big moves. But when it comes to stocks and to crypto, 3-to-1 is you can go much bigger than that, because especially with volume profile, you can have really tight stops and re-enter it. Let's say, this guy that I've been mentioning in the Discord room, Christian Kulumagi, who is a great trader. He's rolling in money, and he started only with $2,000. It took him 10 years to grow it to almost 100 million. And he actually only has a win rate of 25%. But he makes at least, I think, 1 to 25 is his risk reward.
Right. Is he trading typically based on breakout patterns, as an explosive of compression volatility into expansion of volatility?
I can post his I can link his blog in the Discord room. He has basically just 3 setups.
Right.
And it's parabolic breakout, like breakout and parabolic move, and then he has, or parabolic rally, or whatever you call it, and then he has the parabolic short, like after a huge run up, he tries to short that, and then he has something else. I don't know what it's called. I'm not particularly interested in his trading style right now, because he trades small cap, low float stocks. Stocks that can go, for example, from $10 to $50 in a matter of days, stuff like that.
Right.
He doesn't trade blue chip stocks like Amgen or Amazon or these kind of things. Now, obviously, you said holding on to a trade for this long amount of time, even after you have reached 3-to-1. Now, this is we don't have to talk about this, but obviously when you trade stock CFDs, there's swap fees for every night you hold a position. So these can really bite off a big chunk of your profit. So you have to be considerate of that. But here's the thing. You can, even if you pay, let's say this thing takes another week or so, or 2 weeks or 3 weeks to reach the target. Even after swap fees, you still made a lot of money, especially if you utilize margin as you can with GP stocks. Obviously, you don't have to risk 1% here. You can say you risk, let's say you're aggressive, 3% on this trade, and you can make 21%. Profit on this one trade. So it may take 1 month or 2 months to reach the target, but you are still making more money than you would day trading, trying to catch like 1% a day or anything like that. And let's be honest, how many traders actually do that? I tried this when I started Forex, and it just, as Christian Kulumagi put it very, very well, he said short-term trading will drive most traders into bankruptcy and drive a lot of them insane. And he is absolutely right. You can catch like this trade here. Like for example, GP offers 80 stocks. If you just catch let's say a dozen of those wedge pop trades like this in confluence with volume profile levels, you can make like 20% on
Yeah.
the trade,
Yeah.
across. And if you I mean, it may take a few months or weeks to reach your profit target, but over the span of a year, you make much more money than someone who tries to day trade.
Yeah.
So
How do you find trading multiple stocks at the same time and the correlation nature of these stocks if we see, let's just say, the S&P 500 or the Nasdaq selling off at the same time? Do you have any rules around that?
Well, I use scanners as well, and I'm new to those, so I'm looking at stocks that outperform the market. You can generally, for example, if let's look at the SPY here, the spider. If it breaks here in the beginning of or mid-May, it gapped down and broke below the two moving averages here. And if you have stocks when the spider, when it sells off and breaks below moving averages, if you have, for example, a stock that at the same time is above the moving average and is also gaining in value, you obviously have an outperformer here. So you can, this is, it's not an exact science, but with Finviz or MarketSmith, you have great screening softwares or providers that you can gauge which stocks will outperform the SPY, for example.
Okay. You can work that out. Perfect. How long do you, so essentially what I am sensing out of this explanation is that your average holding time might be 1 to 2 months at times? Weeks to
I think
a few weeks to a month.
exactly. A few weeks. I mean, I traded Alibaba and Tesla.
Yeah, perhaps you could just show us a few other stocks that we haven't touched.
Yeah.
We're having an overdose of AMGN for now.
Sure. Just one thing,
Yes.
because I wanted to mention where I entered. As you can see right now, I
Right.
marked this week here. This was the last trading week prior to this current one. And as you can see, the price, where did it drop? It dropped, if you let me zoom in a little bit more, look where it went to on I think it was Tuesday. Yeah, on Tuesday, it dropped right into the value area high zone. You see this?
Yeah. See
Of
that.
last week, and then it jumped up again. And so this is I will show you in later examples. I kind of try to realign my entries with weekly volume profile levels. So I missed the initial move here, the initial entry. So what I do is I look at volume profile levels of the weekly chart, and then I enter there. And maybe it will take out my stop. It happened with NI that I posted in Discord. It took me out. It happens, some trades take, now coming back to your question, let me go to Tesla. This is one that I trade. I actually caught Nike as well, which made a huge gap up, and I want to show you this one as well. I actually already closed my position here. It hasn't reached my profit target, but it kind of just moved sideways, and I wanted to relocate is that the right word?
Yeah.
Some of my, exactly, into other stocks. And you see it broke out of this wedge. It didn't come back yet, as of yet. It might come back. So this was a very fast move if you kind of traded this gap up. But I posted this, I entered somewhere back here, and it didn't move anyway. It just moved sideways. So I closed my position, and as soon as I saw this gap, it gapped up here on 23rd of June, and that's when I re-entered. So sometimes you can do that, because obviously it can be very frustrating to enter somewhere around here and then just wait for it 2 weeks and it doesn't do anything. But I can actually show you why I entered this.
Yeah.
See this huge volume profile that I slept on here. We had this wedge here. Let me go a little bit bigger. You see this huge wedge here that we broke out of.
Yeah.
Now, obviously, my logic behind that is I want to see. Obviously, I want to see in this whole move, the wedge and the up move, where was the most volume traded. And as you can see, it was down here. And here we had the volume area high with a big volume node. And look at this. This was at 585. Look at how it respects this level. It just can't break below it. It keeps trying to crack lower, but it just doesn't happen. So, and here again, my logic, you see this earnings were released on the 26th of April. What did I tell you earlier? We look for these setups around the earnings release, maybe a month before, maybe a week or so later. So what happened here? Earnings release, positive earnings. And this is another thing. Many traders try to trade earnings release the day of the earnings, and they wonder, well, the earnings are positive. Why is the stock dropping? Because don't focus on the earnings date per se. Focus on the weeks prior to that or afterwards. This is where the setups actually emerge. And I can say, on TradingView or forums, you don't find anyone doing this. They are all so focused on this one particular date. Don't do it. Right. The big guys, they are setting up their trades long before earnings release. You know, so you don't think you can outsmart them. So obviously, as you can see, we had this earnings release, price dropped down right into the value area high. Look at this. I mean, it dropped a little bit lower at a little bit below the 200 moving average, and then what happened? Look at this. You see the wedge. Like Oliver would call this a wedge. It dropped below the 2 moving averages, the fast moving averages. It formed a wedge. It popped out of the wedge, like here. You see the pop out. And this, you could have entered as soon as we see, shortly after earnings release, a sell-off into a significant volume profile level, like here. You can already say, I'm entering if you're very aggressive, because this is obviously a sign that they're up to something. Those big traders who sold off here, I don't know how exactly what they are thinking, but again, and here's how we could have, maybe you don't want to enter like risking trying to catch the knife here. So look, we reached the volume area high around the 12th of May. And again, what do? And this is something that I haven't found anyone who does this. So the 12th of May. So what we are going to do is we mark this whole trading week. So we have these 5 trading days here. Let me readjust my volume profile a little bit. And this is the new trading week. On the 17th of May, we open below it, so this is of no interest to us. It has to open above it, obviously, for us to go to kind of catch a retrace. Then we mark the second trading week. This is this here. Now look at this. Price broke out of, like on the 3rd week after touching the value area high, price broke out and we have a wedge pop, what Oliver Kell would call a wedge pop. And look where price retraced to, right into the POC. Look at this. I mean, a few dollars below it, and this is your entry. You could have, I mean, think about this. This is a trade that this setup, you can plan it a week in advance, or 2 weeks in advance, or even longer. So this would have been your entry. You don't have to sit in front of the screen.
Yeah, Ivan, what confirms, sorry, I apologize if I interrupt. What confirms the breakout of the wedge pattern? Is it a diagonal that you draw, or is it the price closing above the 20 or the 10 moving average?
So again, the wedge pop isn't my idea. This is Oliver's idea, but I'm
Yeah,
trying to
yeah,
incorporate
yeah.
into this whole process. I'm trying to
In
make it a little bit safer.
right.
And what for him, the wedge pop is a consolidation below the two moving averages,
Okay.
these two here,
Yeah.
and then a breakout on significant volume. You can't see the volume here. Let me switch to my other. I have a couple of charts for, and so you can see, oh, well, it didn't have significant volume here. The volume actually dropped off.
Yeah.
So this factor wouldn't be optimal. But, and here's the thing where I kind of enhance or improve his method with volume profile. But anyway, yeah. So this is it, a consolidation between below the two moving averages and a pop out of it.
Out of
So
it,
you
meaning above the closest or the farthest moving average, meaning the 10 or the 20. Do you want to see a close above the 10 or above the 20 in price wise?
I'm actually not sure. I think, well,
Right.
definitely above both.
Okay,
I
above
can
both. Okay,
show
above the
you
20 then.
some screenshots of his book where he explains it much more in detail. I haven't read through the entire book
Okay.
yet. So yeah, I mean, you can draw this wedge, obviously, like this is the wedge, and here this is where the stock really breaks out of the moving averages and the wedge. It's not an exact science, like it's not looking perfectly all the time. You have to kind of develop. But here's the thing how, for example, I wouldn't kind of pay much attention to the volume like down here, because look at this. We kind of anticipated the wedge pop already because it consolidated at the value area high of this huge rally. You know, it just can't break lower.
Yep.
And you also have 200 MA, and it comes and consolidates. It breaks out of this. You have 2 weeks. You see these two trading weeks that I marked here. The point of control is pretty much the same.
Yep.
So we wait for the breakout. We wait for a retrace into the weekly POC. And this is actually where I entered then. And then I closed after it didn't move for 2 weeks, and then I re-entered on the breakout. So
let me ask you a few questions that are kind of like straight to the point with a punchy answer from your side, if possible, because there are a few lining up. So number one, whenever you said that the volume was breaking to the upside in Tesla, but it was suboptimal because it was decreasing volume, would you actually make a distinction in your risk appetite, like meaning perhaps if you see that your entry would be half the normal risk, or would you always assign the exact same risk per trade?
I don't pay as much attention to volume as Oliver does, because my theory is by the time you see huge volume, you're already too late. You obviously you can ride the coattails of the big traders, but I like to I try to, as you can see with my approach, to enter before the big volume comes in.
Okay.
And you can do that using the volume profile.
And Titan, yeah, go ahead. I'll let you finish. Thought you were done.
Because they are very cunning, the big player.
Right.
And
yes.
by the time you see them with huge volume and huge moves, they've already been, you know, opening their positions and preparing that. So you want to kind of try to enter when they are stealthily entering the market, and not when it's already breaking out and all that on huge volume.
Yeah, good point. So Titan Black is asking, how do you deal with gaps in stocks? Is it something that has, or in the past or in the future, you find that might be concerning for you, having an open position, and how you deal with gaps?
So far they haven't played against me, so I'm
right. Well, this is a monumental gap.
Yeah, I was actually in this trade. This is Nike. And
can you walk us through what happened here? Like what the heck happened for?
Exactly, but just I don't want to gloss over Titan's question.
Yeah.
Like gaps are incredibly dangerous, especially when you trade stocks on margin, like we can do on GP. So you have to consider that it can if you, I mean, if you would have shorted Nike, for example, here, it could have wiped out your entire account if you had a lot of, like, a big position. So you have to be incredibly careful with gaps on stocks. Now, the thing is, my approach, I'm pretty confident. Now, obviously, not every setup works out. This isn't like a holy grail or anything. Now, it shouldn't, if you see it gapping down after you enter the trade based on the volume profile level, you probably want to scratch that one. It doesn't bode well. You know, it shouldn't gap down when you try to enter a long position.
Yeah.
It doesn't, you know, it's just, it's weak, the stock then. That's not a good sign.
Yeah.
And yeah.
Can you just remind us, like, whenever you're trading stocks with Global Prime, what are the candle time dynamics? Do you have the ability to trade through the CFDs all day long, or do they open only for 8 hours and then they close and you have to be exposed to that potential gap? How many hours can you actually physically trade these stocks?
No, the CFDs are oriented or based on the regular trading hours. So I don't know what it is like in Australia or whatever. For me, it's 3:30 in the afternoon until I think 10 p.m. That's when.
So just they open for regular hours.
Exactly, regular trading hours.
Okay.
So you obviously have this risk window,
yes.
and I don't think, from what GP doesn't offer pre-market trading, or you know, so some traders use pre-market hours, but we can't do that with GP, unfortunately. But it's not that important, actually. So yeah.
All right. Now, in terms of your favorite markets to trade, is it fair to say that right now your whole focus has shifted into just stocks, or whenever cryptos come back in style, you might also be looking into trading this same methodology into some cryptos that you might find to be compelling, the setups?
Right now, I have a little bit skin in the game in crypto, of course, but I'm not doing anything until Bitcoin reaches 100K. So I don't.
Right. Okay. So you might have to sit patiently for quite a while.
Yeah. With crypto, I wouldn't trade anything else than Bitcoin and Ethereum, to be honest. Maybe Litecoin. For some reason, this one doesn't go away. But with crypto, even if you trade Bitcoin and Ethereum, it's really just one market. The one lags behind the other. You know, so it's basically like one instrument. Crypto is. I'm not sure what to make of it. I had like a good life trading crypto. It provided me with immense freedom, but I've kind of distanced myself from it since 2018. But I do think at some point I will go back to it, but more in a long-term way, just to, you know, put more money into it and hope that Bitcoin will just keep moving upwards.
Yeah.
Who knows?
And up to this point, do you still find yourself at times keep over optimizing or over refining certain parameters of this methodology, or would it be fair to say that for a consistent period of time now, be it 6 months, years, you have maintained the exact same approach, and that is really that really portrays your potential consistency if you've been able to have very few tweaks and you just essentially stick to one way of trading and approaching the markets. So if you could just give me a short answer on that front.
Yes, the method, like I said in the beginning, it's just an evolution of something that I've been doing for a long time. The idea is really buy low, sell high, and you see we do this. Just I am still, the things that I've been posting recently in the forum, I'm tweaking it. I'm incorporating some aspects, some trading approaches from other successful traders, obviously. And so there's still some things that I haven't completely figured out yet with what is like an optimum approach. So there's a little bit of tweaking, but the general thing, it's just the same.
Yeah.
We just
And I suppose that also I gotta recognize from my side that that's a tricky question, because as traders we always have to become ourselves adaptive creatures to the market and to the ever evolving and changing conditions. So it's not something that you always want to think this is going to be fixed in stone. There's always going to be a little bit of room to make adjustments whenever those adjustments are required based on changing dynamics and so forth. It's just being aware of where you draw the line, because at times over optimization leads to eventual confusion as a trader, and then before you know it, you have completely changed how you trade the markets. So yeah, fair point, and good.
Especially with stocks, and with stocks, you don't really. There are methods. There are traders, successful traders with a verified track record, who have been trading methods that are like decades old. Stocks, and that's what I love. Stocks and also crypto. You are trading an object or an asset that has the tendency to go up.
Yeah.
So really your job is to find a good spot to enter low and then sell high. That's all you do.
Yeah.
And this won't change as long as the stock market, as the companies grow and all that. Obviously there are companies who can go bust. I mean, look at General Electric. It's just going
But
down
I mean,
all the time.
if you think about it, there is a logical answer as well. Like, thinking from the perspective of monetary policymakers, politics, they get elected every 4 years. For them to continuously be elected, the economists need to do well. If the stock market is going to be dropping, they're going to be in trouble. People are not going to be happy. People are not going to see the money rolling in. And they're going to do whatever it takes. And in the last 10 years, the proof is in the pudding. The Federal Reserve has been artificially inflating this the stock market to keep having that upward motion and trajectory. And it gets better, which is, and that's a great point that you've made. If you do not believe on the point that you're defending here, which is this is an object that tends to move up, just go back in history, 100 years, and just look at a yearly chart of the S&P 500, or look at a year, like maybe you can just go to a yearly chart or monthly. There you go. Nike. We can talk about Amazons of the world. We can talk about the index as a representation of it, like the S&P 500, the Nasdaq, which I do believe the Nasdaq being such a tech-oriented stock, and now with this shit show of pandemic, if you will, everybody trapped at home, there's going to be some of the heavyweights within that index that are going to be doing very well. I mean, it's just been a gift in disguise, right? The pandemic for these tech stocks. So. Yeah, I mean,
this is actually very interesting when you, I think I was hoping for some critique here, because Greg would obviously say, well, because we have a bull market right now, it's much easier to kind of like catch a dip or a sell-off and then ride it upwards again. But again, I want to remind you that for me, an important thing is the earnings reports. The time frame around them. And if you look at, we are here at Nike now, for example, I mean, Nike isn't a high growth stock. It's not really that big of a deal here, but still, when Corona hits, you know, we had this huge sell-off across all markets, across all stocks and everything. But if you look at this, we wouldn't have even looked for a setup right here. This is 24th of March 20. This is where we had an earnings release, and the last one was in December. So we had this huge window, and it's with a lot of stocks. We wouldn't even have looked for a trade opportunity in that period. We would have stayed clear of this mess here. Now maybe I would have entered somewhere. I didn't really pay attention that much to it. But you are not, if you orient yourself towards the earnings release dates, you can stay clear of a lot of trouble, because there are a lot of bad setups in the time between earnings releases. So this is another crucial factor.
Yeah. Okay. So last one or two questions, and then we're going to wrap it up. So Titan is asking, and please, if you don't understand the question, I will ask him to rephrase it. He says, humans said you could treat them, I'm not sure what he refers as them, as invisible candles. Is that so? Not sure I'm following that question. He's saying, humans said you could treat them as invisible candles. Is that so?
Does he mean the gaps?
Right. So, Titan, if you don't mind, could you just please elaborate on what you mean by treating them as invisible candles? And so I also was interested, as the last question before Titan hopefully rephrases that one, that have you actually gone through rigid backtesting in sample or out sample in order for you to gain conviction on this setup, or have you just been solely focused on trading real-time data without the need for you to go back into years of data? Like,
that's maybe probably one of the hippos asking that there. So
no, that's just mine. It's just my own.
Oh, all right,
Yeah,
because they're so hell bent on backtesting.
Yes.
I think it's obvious. I'm trading forward. I'm not. I mean, I obviously go back in charts for many years and just look at those time frames of earnings release and everything to kind of optimize it. But I think it's obvious that you cannot backtest this properly. I mean, how do you do this? There's no software that can kind of. As you can see, the way that I anchor the volume profile is often completely different to what others usually do.
Well, I guess I wanted to emphasize manual backtesting or visual backtesting by going back and then making a visualization and a simulation of these trades as they happen in the past, because that is something that obviously, if you stay honest and stay honest to yourself and humble, then you could, I guess, draw some conclusions out of it. Have you ever done that?
No, my idea was actually to go on with Trader Evolution. We actually have, the trade reports or whatever you call it, and it has a great, it analyzes the Sharpe ratio and all that. And my idea was to just see how the rest of the year goes, now that I'm pretty much just trading stocks with GP, now that the offerings are, like, the selection is bigger, and just maybe publish my Sharpe ratio and my profit curve and all that at the end of the year or beginning of next year. But like manually back testing and kind of like with some sort of software or anything, I don't do that. I don't think it, makes sense with this kind of approach here.
Okay, excellent. So that will do for today. Titan hasn't gotten back to us. We've gone for over 1 hour and 10 minutes. So I guess that makes it a pretty good, valuable session for all of those that have been connecting today with us. I appreciate your time. Yeah. I think I definitely have a better grasp of your explanation, your methodology. Is there any one final message or just something else that you'd like to share with us before we conclude, or some other chart that you had in mind to share? That
I mean, not really.
Okay.
It's just we really just scratched the surface. This goes deeper, and I'm trying to. I mean, if there's interest, I can share more about this in the Discord room.
Exactly.
I'm just doing that because I think I've been there. I've burned so much money trying to day trade Forex pairs and all that. And this is really a much better approach. Just do it like this. It's not exciting. You may have to sit in a position for a long time, but over the span of a year, you will make much more money than trying to catch intraday movements and all that. So, and I think you can do this best with a volume profile. It's such an incredible edge. And I'm really surprised that so few people actually use it. So, yeah.
Well, I mean, I guess that it is true that the less that a tool gets to be promoted to the masses and the less eyeballs that one tool's got, I suppose that maybe you get to have a distinctive advantage because you get to read the markets in a way that others don't. So maybe that's something that also can reinforce your trading edge. I mean, I've seen many people using volume profile, not so much in the Discord room, in our Discord room, but there's definitely this is something that is like in the financial domain. It's a very well-known tool, the volume profile, for sure.
Especially, and I don't want to ramble on, but with a volume profile, what a lot of people, again, I mentioned it earlier, you can't just, like, look at this. You can't just anchor it to this point and then to that point, and just
it's
think
all
that
over.
it will,
Yeah, high volume nodes are all over there.
Exactly, and you can't just think that it will. I mean, here it bounced obviously, but it doesn't work like that.
It's more kind of like a guessing game if you're going to be drawing it from that bottom to the top.
Exactly, you have to look at the area that you are already interested on based on your other analysis, and then look at the volume profile there and make the decision to trade on. Because this is the last chart that I want to show, just to exemplify this. This is Disney. I've been in Disney for a few days now, and it's really not doing well. It just doesn't move much, especially considering that the SPY is moving slowly upwards. So Disney is a little bit selling off, so it shows weakness. I don't like that. But here it's the same thing again. If you look at this, here on the 13th of May, we had earnings reports. Yeah, it sold off. Again, the same pattern repeats over and over again. Once it sells off and it forms a wedge, you see, it starts forming a wedge below these two moving averages. This is the area of interest to us.
Yeah.
You see this consolidation area, then it gapped up and it started rallying. So this is the area we want to slap the volume profile on. We don't care what happened up here or anything. And now look what happened. Look where the price, it went to the POC and to the value area low. Look, it's almost to the dollar. It stopped right dead in its tracks. It started consolidating between below those two moving averages, and then it broke out. And as you can see, where did I put my volume profile? Again, I put it in this breakdown and consolidation area. I want to know where the big money traded inside this particular area. And as you can see, this high volume node at the value area high, look at this. The price broke out. We had this wedge pop. It drifted back into the volume area high. It's been kind of consolidating, and now it broke out again.
Yeah.
So as you can see, and I entered, I don't even know where I entered. I have to look at my other computer. But anyway, as you can see, this is the interesting thing. I could have closed my position by now because it's obviously not doing much. It broke out of this downtrend line and then it retraced. But here's the thing. Look where it retraced to. I marked the previous trading week, last week.
Right.
And this week, from Monday onwards, it sold off right into the POC of last week. Look at this. It touched it to the cent.
Yeah.
Which also happens to be where? The value area high of this consolidation prior to the wedge pop. You see it all comes together, but you can't just blindly slap on volume profiles on movements, on up or down moves, and try to work with them as support and resistance areas. But if you look at this, it all comes together. So you have a little bit of conviction that now this, okay, it showed some weakness, but I'm not, I'm staying in here no matter how long either it takes out my stop or we go back to, my, let's say 193, which is a volume profile area. Again, I mark this down wedge and I mark the value area high. This would be my profit area.
Yeah.
So, yeah.
Makes a lot of sense. So for those that have gained enough insights that now you've concluded you want to learn and get more into the nitty and gritty of this system and this methodology, I suppose that Ivan is going to be happy just to keep sharing his knowledge base as it orbits around this trading methodology in our Discord room. I really appreciate, and I told you so even before the meetup, because I do actually reach out to traders, and the majority of them, they're just shy, and they just don't, kind of like, they want to, I suppose, keep it for themselves or turn down the invitation. Some others are going to be accepting it. Thanks for accepting today's invite and just walk us through your methodology. And I will just keep doing my best to bring more guests and more approaches, so that, I think it's a good exercise to see how many ways there is out there to skin a cat and to trade the markets, almost infinite. So, Ivan, any final words before we wrap it up?
No, just
I appreciate
if there are some of our viewers want to poke some holes into my methodology, they're welcome to do this. That was also my initial idea. I was hoping that maybe one of the hippos would jump in and kind of try to tear me apart or anything. I love their very skeptical approach. This is no insult. I mean, this is what we need in this space. And if someone wants to learn more about this, about my method, which I think is a very solid edge, it's not time consuming. I've been sitting in my positions for a while now, and I just don't do anything else. I just monitor them.
Yep.
And I don't want anything from you. I don't mind sharing my setups and explaining a little bit how I go about it. And you can do this while working full time on the side. It's a very slow but very high probability method. So you would do yourself a disservice if you ignore volume profile trading. That's my message.
That's become super clear after this 1 hour plus conversation. So Ivan, thank you very much for your time. I'm gonna be now wrapping things up, and I'll see you in the Discord room. Let's keep chatting there. Thank you everybody for joining in today. Cheers.
Cheers.
Bye.